All right, today we are tackling a really big one, capital gains under the brand new Income Tax Act, 2025. You know the old 1961 Act is officially out, and there's a new charging provision in town, Section 67. For all you tax professionals out there, getting this right is, well, it's absolutely non-negotiable. So let's just jump right in.
Okay, so let's imagine this. You've just sold an asset, or maybe one of your clients has. The first question that pops into your head is, okay, how is this profit going to be taxed now? The new law talks a lot about simplicity, but as we all know, the devil is always in the details. And that's exactly what we're here to unpack today.
So here's our game plan. We're going to start with the absolute foundation, Section 67. Then we'll get into the nitty-gritty of the core calculation. We'll also tackle a really tricky area, partnership firms, before diving into the super important 1961 to 2025 transition. And of course, we'll wrap up with compliance pitfalls and a handy checklist to keep you on the right track.
All right, first things first, let's start at the very beginning. We're talking about the foundational charging section that's going to govern pretty much every capital gains transaction from the tax year 2026-27 onwards. So, the good news is the core definition hasn't really changed. A capital gain is still, the profit you make from the transfer of a capital asset. But what has changed is where this rule lives. Think of Section 67 as your new single source of truth. It brings everything together that used to be kind of scattered all over the old Act.
And it really all boils down to these three key pillars. It's actually pretty logical when you think about it. First, you need to have a capital asset. That makes sense. Second, there has to be a transfer. And third, the Act lays out a very specific method for computation. Honestly, if you can get these three things right, you've pretty much mastered the basics.
Okay, so let's dig into that third pillar a little deeper. We're talking about the actual math now. How do you go about computing the gain that's ultimately going to be taxed? And here it is, the basic formula in its simplest form. You start with what's called the full value of consideration, which is just a fancy way of saying the sales price. From that, you get to subtract three key things: your cost of acquisition, what you originally paid for it, the cost of improvement you've spent, and any expenses on transfer, like brokerage fees. Whatever's left over, well, that's your capital gain.
But let's look a little closer at these components, because they matter. For long-term assets, you get this really crucial benefit called indexation. This basically adjusts your cost for inflation, which is a huge deal. Now, in some specific situations, like the deemed transfers we're about to get into, the law doesn't use the sale price. Instead, it uses fair market value. And just remember, if the tax officer isn't convinced by your valuation, Section 91 gives them the power to call in an official valuation officer. So you've got to get it right.
Okay, let's shift gears to a really important, and let's be honest, often complex area that affects so many businesses out there. We're talking about the taxation of partnership firms when they go through a reconstitution or even a dissolution. The good news is, the new act actually brings some much-needed clarity here.
So here's how it works now, under the new Section 67, subsection 10. When a partner gets a capital asset during a firm's reconstitution, the law treats it as a deemed transfer. Now here's the really critical part. It's the firm itself that pays the capital gains tax on this. And the sale price isn't what's on paper, it's the asset's fair market value on that date. And if that wasn't enough, the new Rule 50 from the 2026 rules tells you exactly how that gain gets attributed to the firm's other assets. That's a huge detail you can't miss in your accounting.
Okay, now we're getting to what is, in my opinion, probably the most critical section for any practicing professional. The big question is, how on earth do we handle transactions and claims that bridge both the old 1961 Act and the new 2025 Act? The answer lies in the transition provisions. They are absolutely key.
Think of this slide as your handy little cheat sheet for the transition. The old Section 45.4 for firm reconstitution, that's now Section 67.10. The special computation for partnership firms that was in Section 48.3, you'll find that in Section 72.5 now. And what about that really helpful rule for non-residents, the one that let them calculate gains in foreign currency? That's also been preserved, and it's now in Section 72. This mapping is it's vital. You need it to apply the law correctly.
So I get this question all the time. What happens to my old capital losses from before 2025? Well, I've got some good news for you. Your right to carry them forward is preserved.
The transition FAQs make it really clear that losses brought forward from the old regime can be set off against gains under the new act. But, and this is a very important but, the set-off has to follow the old rules. So for example, a long-term loss from the old days can still only be set off against a long-term gain under the new law. The character of the loss doesn't change.
So while your old losses are safe, your old exemptions, well, they can be a bit of a trap. This quote right here, it just sums up the new clawback provision perfectly.
Let me walk you through an example, so this really sinks in. Let's say you claimed an exemption under the old Section 54 back in March 2025. You bought a new house, and it came with a 3-year lock-in period. Now fast forward to May 2027. If you sell that new house, you've just violated the condition. And that's when Section 5362H of the new Act kicks in. The exemption you thought you had, it gets clawed back and becomes taxable income in the tax year 27-28, all under the new law. Ouch.
Okay, so we've got a decent handle on the law itself. Now let's switch gears and talk about the practical stuff, compliance, and what you really need to watch out for.
All right, let's talk compliance. First up, documentation. This is always non-negotiable. Keep every receipt, every agreement. Now, specifically for you partnership firms dealing with those deemed transfers, there are 2 must-haves. You need an official valuation report for the fair market value, and you absolutely must file the new Form 27 to report how the gain is attributed. And, of course, the golden rule, never ever miss a deadline.
Here's another one of those tricky practical issues that I see popping up with this transition. What if you put money into the capital gains account scheme, the CGAS, under the old law to claim an exemption, but the time limit to actually use those funds expires after the new act is already in place? What happens then?
Well, the answer is actually quite clear, thankfully. The transition rules say that if those funds are still sitting there unutilized when the time is up, that amount will be treated as a capital gain. It gets taxed in the year that the period expires. And here's the key part. It will be taxed under the rules of the new Income Tax Act 2025.
Wow, we have covered a lot of ground today. So let's just take a moment to pull all of this together. We'll consolidate the most important points into a simple checklist that should really help you navigate capital gains under this new regime.
So, let's recap the absolute essentials. Number 1, your go-to section, your starting point for any gain is now Section 67. Got it? Good. Number 2, be extra careful with partnership firm transactions. Remember, those reconstitutions can trigger a deemed transfer and a tax bill. And number 3, really get to grips with the transition rules. Know that your old losses are safe, but also know that your old exemptions can be clawed back. And underpinning all of this, solid, watertight compliance.
And that really brings us to our final thought for today. You know, the whole point of the 2025 Act is to simplify things. But this transition period, it's going to demand a lot of diligence and a lot of precision from all of us. So the one key question you should be asking yourself and asking your clients is this: are your records truly ready for this new era of taxation?
Thank you so much for joining us for this deep dive. If you found this breakdown helpful, it would mean a lot if you could show your support, subscribe to the channel, and maybe share it with a few colleagues who might also find it useful.
Just a quick reminder, this video is for educational purposes only and does not constitute professional advice. Tax laws are always subject to amendments, so please be sure to consult your professional advisor before taking any action. This is an AI-generated educational video.